If you have observed the market for any real length of time, you've probably noticed that prices don't simply move, they're moved. And today, as we dig into the UTAD Trap, I want you to listen with the same attention you'd give a ticker tape flashing out the truth behind the market's antics. Before we begin, think back for a moment, because just like the previous video on the hidden accumulation footprint smart money leaves behind, today's lesson is part of the same story, only now we're watching the other end of the campaign. Now, the UTAD, upthrust after distribution, is one of those maneuvers that has seduced more traders than I care to count. It appears innocent enough, a sudden push above resistance, the kind of breakout every novice has been trained to salute. But as the old operators knew well, the public is always hungry for confirmation, and nothing entices them more than the appearance of strength. Tell me, have you ever felt that urge yourself, that little spark of excitement at the sight of a new high? I'll speak plainly, as I always have. The UTAD is one of the most elegant tools in the composite operator's chest. It's the finishing stroke of a distribution campaign, and it has a single purpose: to draw out the last pool of buy orders sitting above the highs. That liquidity is precious fuel. The smart money needs it to unload the remainder of their inventory without disturbing the market. So what appears as strength to the untrained eye is, in truth, the final breath of a tired advance. Picture the scene. Prices have been drifting sideways for some time. Volume is uneven, often fading, the character of the waves changing subtly. The public interprets it as a pause before another leg up, but the informed trader reads it differently. If you tune your mind to the behavior of the large operator, you begin asking different questions. Why is price hesitating? Why are rallies becoming narrower, less enthusiastic? And when that sudden spring upward appears, do you see strength, or do you see bait? You must understand that the big operator's intention is never to advertise his plans. He waits for the crowd to reveal their eagerness. He watches for the breakout traders placing buy stops above the range. He notes the emotional buyers who can't stand the thought of missing the move. And when that cluster of orders has gathered densely enough, he lifts prices just high enough to trigger them, only to sell into the very excitement he created. Have you ever noticed how quickly the market can turn the moment you finally decide to jump in? This is the UTAD, a temporary and manufactured appearance of strength. But unlike a genuine breakout, the UTAD isn't sustained. Volume may spike briefly, but the follow-through is weak, hesitant, disinterested. If you compare it to the earlier behavior of the stock, you'll often find a contrast. A sign the composite operator is spending effort to create an illusion, rather than guiding an authentic advance. You'll recall, in that earlier discussion about the hidden accumulation footprint smart money leaves behind, we spoke of how the informed interests quietly build positions without disturbing the crowd. Today's principle is simply the mirror image. They now quietly distribute those positions, and the UTAD is the final sweep to catch what remains of public enthusiasm. It's a reminder that understanding accumulation teaches you to understand distribution just as clearly. What's fascinating is how predictable human behavior becomes at these moments. Traders crave certainty, and the UTAD exploits that craving. You can see it in how quickly traders pile in. They interpret the jump as a signal that resistance has finally been conquered. But if they studied the structure beneath it, they'd notice the signs of exhaustion, shortening thrusts, supply appearing on rallies, decreasing demand on declines. The market whispers these things if only you're willing to listen. Are you listening, or simply reacting? Now, a trader's mindset plays an enormous role here. Many approach the market with the idea that every breakout is an opportunity. The seasoned trader approaches with the idea that every breakout is a question. Is this genuine strength? Or is this an operator's trap? Developing that mindset is part of wealth building, not the kind that promises rapid riches, but the kind that grows through discipline, patience, and the consistent reading of behavior in the markets. Think for a moment about how money flows. When the public buys at the UTAD, believing they are catching the next leg of the bull run, they are in fact handing over liquidity. They are providing the very orders required for large interests to close their longs and sometimes even begin building shorts. And once that exchange is complete, the market no longer has the support it needs to remain elevated. Prices slip. Then they slip again. And soon the very traders who bought the supposed breakout find themselves underwater. Have you felt that moment of bewilderment when the market feels like it betrayed you? But the market doesn't betray. It reveals. And if you align yourself with the principles rather than the emotions, you begin to see that what feels like chaos is actually choreography. The UTAD is choreographed. It's deliberate. The operator has planned it long in advance, preparing it step by step through the earlier phases of distribution. This is why studying the structure, bar by bar, wave by wave, is far more valuable than chasing indicators or signals. Indicators can be fooled, but the footprints of supply and demand cannot hide. They may disguise themselves briefly, but if you know what to look for, you'll recognize when the market is running out of genuine demand and beginning to manufacture artificial strength. At such moments, the UTAD becomes not a trap for you, but a confirmation that the composite operator's campaign is nearing its end. And consider this. Not only is the UTAD a sign of distribution nearing completion, but it often sets the stage for the next significant markdown. If you're positioned correctly, this understanding becomes a form of protection and even opportunity. You're no longer the liquidity. They are. And isn't that the shift every trader strives for, to step out of the crowd and into clarity? The great operator always acts with purpose. He accumulates quietly. He distributes quietly. He moves the market only when it serves his campaign. And while the public chases the appearance of action, he watches the behavior underlying it. That is the mindset you must cultivate if you intend to grow not just your account, but your competence, your discipline, your financial resilience. So as you watch a market approach its highs, and you see that sudden thrust above resistance, pause for a moment. When we say the UTAD is the final deceptive push above resistance during a distribution phase, we're talking about one of the most misunderstood moments in the market's entire campaign of transferring risk from informed hands to uninformed ones. This single event, this sharp upward thrust near the end of a trading range, is not just a random burst of volatility. It is an intentional maneuver, created by the same dominant operators who engineered the structure leading up to it. And if you're willing to examine the behavior behind it rather than the surface appearance, you'll begin seeing the truth that most traders overlook entirely. The idea is simple, yet profound. The UTAD is not strength. It only looks like strength. And the moment you grasp this distinction, you'll find yourself reading the market from a far more advantageous position. Think of how often traders are taught to buy breakouts. They wait patiently for price to breach a well-recognized level of resistance. They believe this is the moment when the market confirms its intention to go higher. But ask yourself, why would the market, after spending weeks or even months in a range, suddenly sprint upward only to stall? Why would price show strength for mere moments and then collapse shortly after? What kind of genuine buyer behaves that way? Genuine buyers do not, but professional operators do, because their intent is different from yours. You may be focused on catching a trend, but the composite operator is focused on completing a campaign. By the time the UTAD occurs, he is no longer accumulating stock. He is unloading it. He is distributing his inventory, bit by bit throughout the entire range. However, as the distribution matures, fewer buyers remain. The enthusiasm that once supported the uptrend has dried up. The public has grown uncertain. Volume becomes irregular. Every rally loses a little vitality. This is not weakness that suddenly appears. It's weakness that has been developing quietly and steadily. Now imagine you are that operator. You still hold a final portion of a large inventory that must be sold at the best possible price. But if you begin selling aggressively inside the range, you will push prices down prematurely, alerting the market to your intentions. That is the last thing you want. You must create demand, real or artificial, to finish distributing without damaging the price. How do you do it? You exploit the public's reliance on obvious signals, and there are few signals more obvious than a breakout above resistance. The UTAD is engineered to appear as a genuine breakout, designed to attract breakout buyers, stop hunters, emotional chasers, and anyone waiting for confirmation. The moment price surges above the prior highs, a flood of orders is triggered. Buy, stops, market buys, breakout entries. This is the liquidity you, as the operator, need in order to sell the remainder of your holdings without slippage. You are not buying into this breakout. You are selling into it. This is the critical difference. But the deception is subtle. The thrust upward is sharp enough to look powerful, yet short-lived enough to avoid establishing any true support. Once the operator has sold heavy into the spike, the demand that carried the breakout evaporates quickly. The market, now stripped of genuine buying interest, begins to drift downward. And because the breakout was false, the participants who entered during the UTAD find themselves trapped in losing positions almost immediately. Many panic. Some deny. Others place stops too close, and those stops become fuel for the next wave downward. The UTAD is not just a technical pattern, it is a psychological trap. It weaponizes the beliefs of inexperienced traders, beliefs such as breakouts mean continuation, or new highs confirm strength. The operator knows these beliefs well. He counts on them. He crafts his campaigns around them. If traders bought intelligently, patiently, and with structural awareness, the UTAD would fail to attract liquidity. But traders rarely behave rationally. They behave emotionally. And emotion is predictable. That predictability is what makes the UTAD so effective. It is the final sweep, the last shake of the tree, the last extraction of public demand before the markdown phase begins. And if you look closely at the structure preceding a UTAD, you'll notice that signs of supply have been present long before the thrust. Narrower pushes upward, increasing selling on rallies, weakness on downswings that fails to recover with the same force. These are the footprints of distribution, the quiet, methodical steps of a large operator preparing the trap. From a mindset perspective, recognizing the UTAD reinforces a valuable lesson. Trading is not about reacting to signals, but interpreting behavior. The mere act of price crossing a level means nothing. The quality of that move, its volume, its context, its relationship to previous waves, tells you everything. When you develop the discipline to wait, observe, and interpret, the UTAD becomes a moment of clarity rather than confusion. You stop being the liquidity and start recognizing where the liquidity is being taken. And when you train your mind to stop chasing breakouts blindly, when you instead watch for the telltale signs of exhaustion near the highs, you begin to see how the market's strongest moves often serve a hidden purpose. That purpose is not to invite the public aboard. It is to allow the professionals to exit quietly just before the next major phase unfolds. When we say smart money uses the UTAD to trigger buy, stops and gather remaining liquidity, what we're really describing is one of the most strategic and calculated maneuvers in the entire distribution process. To truly understand this, you have to look beyond the simple idea of a false breakout and see the deeper intention behind the move. Large operators don't push price above resistance simply because it looks dramatic on a chart. They do it because that area, just above the highs, is where liquidity hides. It's where the public places buy, stop orders in hopes of catching a continuation. It's where breakout traders lie in wait, convinced that the next leg of the trend will unfold the moment price breaches that ceiling. And it's where emotional traders finally give in and say, "All right, I don't want to miss this move," placing market orders at the very worst moment. All of that creates a pool of buy orders, liquidity, fuel, and smart money needs that fuel to sell the last of its inventory at premium prices. This is why the UTAD exists. It's not random, it's not accidental, and it's certainly not a sign of genuine strength. It is a liquidity grab engineered with precision. Think about it from their perspective. Imagine you hold a massive position, far larger than what any retail participant could even consider. You can't just dump that size into the market whenever you feel like it. If you did, price would collapse instantly, alerting everyone that the move is over. So you must sell into demand. You need buyers. You need enthusiastic, urgent buyers who are willing to absorb what you're offloading without realizing they're taking the other side of your campaign. and the best place to find such buyers is above the highs, where their stops and breakout orders are stacked like dry tinder waiting to be ignited. But smart money can't simply ask the market to hand over that liquidity. They must create the illusion that causes those orders to trigger. So they drive price upward quickly, just enough to poke above the resistance level. They don't need to sustain it. They only need to reach the pockets where the stops rest. It's like lifting a lid just enough to grab the last scraps inside before letting it fall shut again. The moment those stops trigger, a burst of mechanical buying floods in. And while the public thinks, this is it, the breakout is happening, smart money is on the other side, quietly selling into that surge. Have you ever wondered why these breakouts often fail so quickly? Why a price spike above resistance can reverse within minutes or hours? It's because once smart money has collected the liquidity they needed, they have no reason to maintain the illusion. The purpose of the move isn't to start a new uptrend, it's to complete distribution. When the last wave of buying dries up, and it dries up fast, there's nothing left to support the price. The market, freed from the temporary manipulation, begins to drift back into the range or even below it. And when it does, traders who bought the breakout suddenly realize they've been caught. But from smart money's perspective, this isn't malicious. It's simply how the market must function when large interests need to exit positions without destabilizing price too early. They can't sell their entire holdings inside the range because the volume isn't sufficient. They need a burst of liquidity, and the UTAD provides exactly that. Now consider the psychological aspect. Retail traders tend to place their stops above obvious highs, assuming that a breakout must mean continuation. But smart money knows this. They study behavior. They understand where traders feel safe placing orders. The UTAD is designed specifically to take advantage of this predictability. It's a behavioral pattern as much as a technical one. When price lifts above resistance, traders feel validated. They believe the market is confirming what they suspected all along. But validation is often the emotion that precedes a trap. The elegance of the UTAD lies in its timing. It doesn't appear early in a distribution phase. It emerges only after smart money has already unloaded most of their position and needs only that final injection of liquidity to finish the job. It's the last sweep of the net, and once that liquidity is collected, the entire character of the chart shifts. Demand evaporates. Supply becomes dominant. The market begins preparing for the markdown phase, while many recent buyers are left confused and trapped. This is why understanding liquidity is crucial for a trader's mindset. Markets don't move simply because of chart patterns. They move because of orders. Who is placing them, who is absorbing them, and why? When you learn to think in these terms, you begin to see the UTAD not as a trick, but as a logical and necessary step in the life cycle of a market cycle. You recognize that smart money isn't trying to fool you personally. They are simply completing a process that requires liquidity, and the only reliable way to find it is to go where the public hides their stops. And once you internalize this idea, everything about the market's behavior begins to make more sense. Breakouts no longer tempt you blindly. Sudden spikes above resistance no longer excite you. You start asking deeper questions. Why here? Why now? Who benefits from this move? And as you observe these dynamics, you realize that the UTAD is not just a pattern. It is a message about the intentions of those who truly move the market. When we say the breakout in a UTAD is manufactured strength rather than genuine demand, we're describing a truth about markets that most traders never fully accept. Not every upward movement is created equally. Some moves are born from authentic buying pressure, real demand entering the market with conviction and purpose. Others are artificial, engineered for a specific objective, and the UTAD is one of the clearest examples of this deliberate construction. It looks like strength, it feels like strength, and it often triggers the emotional response associated with strength, but beneath the surface it lacks the substance that true bullishness requires. To understand this, you must shift your mindset away from the idea that price up to strong market. Price can move up for reasons that have nothing to do with actual buyers wanting higher prices. Sometimes price is pushed upward strategically, not because demand is overflowing, but because an operator needs to access liquidity. And when that operator is large enough, when they hold enough inventory or enough influence, their actions alone can temporarily give the impression of strength while carrying none of its true qualities. This is precisely what happens in a UTAD. Imagine you're watching a stock or currency pair trade within a well-defined range. Resistance sits above, a clear ceiling everyone is watching. Inside the range, you see fluctuations that don't quite convince you either way. Some rallies, some declines, nothing decisive. To a casual observer, everything looks neutral. But to the eyes of a trained operator, the distribution process is quietly unfolding. Professionals are offloading their positions bit by bit, testing the market, gauging the response. And as the range matures, the presence of genuine demand becomes weaker. It's subtle, but it's visible in the behavior of the swings. Rallies don't travel as far. Selling appears more quickly, and volume often shifts in ways that suggest supply is gaining control. Now, as the professionals near the end of their distribution, they face a problem. They still have some inventory left, perhaps the last 10 or 15%. But inside the range, buying interest has diminished. If they continue selling at that pace in the same area, they risk forcing the market downward too early, before they've fully exited. That would limit their profits, and they're not about to allow that. They need a fresh source of demand, people willing to buy from them at high prices so they can finish distributing at favorable levels. And that's where the UTAD comes in. To create this fresh demand, they need to inspire the belief that the market is breaking upward into a new trend. They need traders to feel excitement, urgency, and certainty. So they produce a movement designed to mimic all the visual elements of strength without containing the actual intention of going higher. Think about how many traders interpret charts. Many rely on simple triggers. Breakout above resistance means go long. They don't look at context, structure, volume, or the underlying purpose of the move. They simply react. The UTAD takes advantage of this reactive mindset. Smart money pushes price above the resistance level just far enough, and often just fast enough, to convince traders that something meaningful is happening. Indicator-driven systems trigger signals. Stop orders fire. Latecomers to the trend see a chance to catch up, and all of this creates a sudden influx of buying in a place where genuine demand hasn't existed for some time. But if you examine the behavior of this breakout closely, carefully, patiently, you'll see clues that reveal its true nature. In a genuine breakout supported by real demand, price tends to show continuation. It follows through. It builds support. It attracts additional buyers over time, not just in one quick burst. But in a UTAD, the follow-through is weak, shallow, hesitant. Volume may spike during the initial push, but it drops off immediately after. The structure begins to sag. The bars narrow. Buying pressure doesn't sustain itself because the people entering the market at that moment aren't long-term holders. They're reactive traders caught in the excitement. Another crucial detail is the speed of the reversal. In a manufactured breakout, the market doesn't linger at the highs. Once smart money has sold their remaining inventory into the wave of triggered buy orders, the market no longer has support. The demand that fueled the breakout was superficial and short-lived. Without smart money participating on the buy side, the price begins to drift back down, sometimes slowly at first, sometimes violently. Traders who bought the breakout begin to feel discomfort. Stops get hit, some panic, others hold on, hoping the breakout will revive itself. It rarely does. This is why recognizing the difference between manufactured strength and genuine demand is so important for developing a mature trading mindset. Genuine demand has staying power. It doesn't appear only in moments of drama. It builds gradually, supports pullbacks, shows persistence. Manufactured strength, on the other hand, is brittle. It relies on illusion. It's created to serve a purpose, and once that purpose is fulfilled, the illusion dissolves quickly. To discern between the two, you have to train yourself to read behavior rather than react to signals. Ask questions like, who benefits from this breakout? Does this move align with the broader context of the structure? Is the market showing signs of sustained demand? Or is this just a sharp poke above the highs? Are the upswings gaining quality or losing it? Is this move inviting participation or exhausting it? Once you begin viewing breakouts through this lens, the UTAD no longer surprises you. It becomes an expected step in the operator's campaign, a predictable moment in the cycle where manufactured strength serves a tactical purpose. And instead of falling for the illusion, you recognize the behavior for what it truly is. When we say the public mistakes the UTAD for a continuation breakout, we're pointing directly at one of the most consistent and costly misunderstandings in trading. The crowd sees price push above resistance and immediately assumes the market is resuming its bullish path. They interpret the move as confirmation, validation, a green light that tells them, yes, you were right to be bullish all along. But this reaction comes not from deep analysis, not from behavioral understanding, but from habit, automatic, conditioned habit. And habits, especially the kind that form without awareness, are exactly what smart money relies on when springing the UTAD trap. Think about how a typical retail trader approaches the market. They are taught that resistance is a barrier, and once price breaks above it, the barrier becomes support. This is a useful principle when genuine demand is behind the move. But very few traders consider the possibility that price can break resistance for reasons that have nothing to do with real buyers wanting higher prices. They assume every breakout carries the same meaning. They rarely pause to ask, why did price break here? Who benefits from this move? What came before it? They just react, and that reaction is predictable enough that large operators can design their strategies around it. When the public sees a breakout during a UTAD, they are reacting to what the chart looks like, not what the chart means. And this is a crucial distinction. The chart looks bullish because smart money wants it to look bullish. They need it to, because this appearance of strength is what triggers the final wave of buying. But underneath the surface, the market is hollow. Demand is weak. The structure is nearing exhaustion. Smart money is trying to get out, not get in. Yet the public sees the same upward movement they've been conditioned to trust and immediately concludes the market is ready for another leg up. This misinterpretation happens because most traders enter the market with an emotional bias toward continuation. They want trends to continue because continuation feels orderly, predictable, familiar. Reversals feel uncertain and uncomfortable. So when they see price spike above the high of a range, their minds immediately feed them a narrative that feels comfortable. The market is breaking out. I knew it. The trend is resuming. If I don't enter now, I'll miss the move. It feels logical, but it's not logic at all. Just fear disguised as conviction. The irony is, the public is often most confident at the precise moment smart money is finishing their distribution. The UTAD is designed to create this moment of maximum confidence. A sharp upward push, a clean break above the range, maybe even accompanied by a brief surge in volume. Everything looks like a strong breakout. The bars expand, momentum spikes, indicators flip bullish. Social media fills with traders calling for higher prices. And all the while, smart money is unloading their remaining inventory into the frantic hands of late buyers. If you've ever entered a breakout only to watch the market reverse immediately afterward, you've experienced this dynamic firsthand. The confusion, the sudden shift from excitement to disbelief, the frantic question, why is it reversing? There was so much momentum. What you were feeling was the difference between how the move looked and what the move actually was. The UTAD is a move that looks like strength but functions as distribution. And the public, focused only on the appearance, walks straight into the trap. It's important to recognize that the public mistakes the UTAD for continuation, not because they're unintelligent, but because the market encourages certain behaviors through repetition. Breakouts do sometimes lead to strong trends during accumulation or markup phases. And when a trader has seen that happen enough times, they begin to associate every breakout with opportunity. They don't distinguish between an environment where demand is fresh and strong and one where supply has been increasing for weeks. They treat both scenarios as identical, even though the structural context is entirely different. The UTAD exploits this lack of context. It presents a breakout in a place where a breakout shouldn't logically occur at the end of a distribution when demand is weak and selling pressure has been building. Yet, because it resembles the clean breakouts traders remember from previous bullish phases, they respond in the same way. They project old experiences onto a new situation without realizing the underlying conditions have changed. This is why developing market awareness is so essential. It's not enough to know that breakouts exist. You must know which breakouts carry real demand and which are manufactured illusions. You must study the behavior of the swings inside the range. Are rallies becoming weaker? Is volume drying up? Are downswings showing signs of supply entering the market? Is the structure flattening, sagging, or otherwise revealing exhaustion? If these conditions are present, a breakout is far more likely to be part of a trap than a continuation. And this is where many traders fall short. They do not ask these questions. They do not study the internal structure of the range. They fixate on the breakout itself, as if the breakout alone defines the future. But a breakout is just a moment, a single bar, a single move. It tells you nothing without context, and the UTAD thrives in the absence of context. When you start to think differently, when you begin to see the breakout not as an isolated event, but as part of a larger distribution narrative, the entire picture changes. You stop assuming every push above resistance is meaningful. You learn to interpret behavior, not just react to appearances. You become a trader who sees the UTAD forming rather than falling for it. When we say the UTAD signals that smart money's distribution campaign is concluding, we're speaking about a moment in the market that marks the final act of a long and carefully executed plan. Distribution is never a chaotic or rushed process for large operators. It is deliberate, patient, strategic. Every phase of it is built around the principle of offloading large amounts of inventory without causing the market to collapse prematurely. And by the time the UTAD appears, most of that heavy unloading has already occurred. What remains is the final sweep, the last extraction of liquidity needed to finish the campaign cleanly. That's why the UTAD is so meaningful. It's not the beginning of distribution. It is the sign that distribution is nearly complete. To understand this clearly, imagine following the composite operator's behavior from the start. After a major markup, smart money begins to reduce exposure, but they can't simply dump their holdings during the first signs of slowing momentum. If they did, the sell-off would signal weakness immediately, causing buyers to retreat and prices to collapse. That would work against them. Instead, they start distributing quietly within a range. They sell on rallies, they test demand, they allow price to move up and down inside the structure while gradually shifting their inventory to less informed participants. As this continues, the character of the market changes, rallies weaken, selling becomes more common, volume behaves differently, signs of supply begin showing up repeatedly in small ways. These are the subtle footprints of a campaign nearing completion. But smart money still needs to unload the final portion of their holdings, and that requires a surge of liquidity, more buying interest than the range alone provides. The average trader inside a mature distribution isn't as excited as they were earlier in the trend. Many are cautious. Many are confused. So to finish the job, smart money needs to create a moment of excitement, a sudden jolt that convinces traders the bull market is resuming. This is where the UTAD comes in. The upthrust after distribution is not merely a false breakout, it is the culmination of everything that came before it. It appears when the campaign is nearly complete. It appears when smart money has already sold most of their position, but still requires fresh buyers for the remaining shares. It appears when the structure has matured to the point where genuine demand is weak enough that only an engineered burst of strength can produce the final wave of liquidity needed. When price surges above resistance in the UTAD, it's not because smart money is accumulating or preparing for a new uptrend. Quite the opposite. They are using that spike to sell what remains. That moment of upward thrust is the final act of their distribution. And once their selling is complete, there is no longer a reason to maintain the illusion of strength. Without smart money supporting price, the market has no foundation. The imbalance between supply and demand becomes visible almost immediately. What follows is a lack of follow-through, a quick stall, and then the first signs of a true markdown. This is why the UTAD is such a powerful signal for traders who understand structure. It tells you that the professionals are almost finished. It tells you that the transfer of risk from strong hands to weak hands is complete. And it tells you that the next major phase, markdown, is approaching. But most traders never recognize this moment because they're focused only on the breakout itself. They don't realize that the breakout is not the beginning of something new, but the closing chapter of a distribution phase. Consider what the market typically looks like right before a UTAD forms. Rallies have become narrower. Price pushes upward but lacks energy. Supply shows up more frequently on upswings. Downswings are met with weaker and weaker demand. The range structure feels heavy, like it's preparing for something. Yet when that final upward thrust occurs, many traders forget all of this context and judge the move only by its appearance. They see a breakout, but smart money sees the finish line. Another important aspect is timing. Smart money will not attempt a UTAD too early. They need to ensure that the majority of their distribution is already complete. If they tried to stage a UTAD while still holding a large amount of inventory, the liquidity produced by the trap wouldn't be enough. The market isn't bottomless. It cannot absorb unlimited supply. This is why the UTAD often appears only after prolonged sideways behavior and multiple tests of both support and resistance. It appears when demand is weak enough to avoid sustained advances and when supply is strong enough that the market is ready to roll over once smart money stops supporting price. From a mindset perspective, recognizing that the UTAD signals the end of distribution can fundamentally change how you approach markets. Too many traders look for tops based on emotion or intuition, trying to guess where the market will reverse. But guessing is unnecessary when you understand the logic of smart money campaigns. Distribution has a rhythm, a structure, a progression, and the UTAD is the final note before the next song begins. If you learn to identify the patterns that lead up to it, you can position yourself mentally and strategically for what comes next. There's also an empowering shift that happens when you realize that tops are engineered rather than random. Markets don't peak because of sudden changes in public sentiment alone. They peak because the people who move the market have finished their business, and the UTAD is the marker of that completion. Once you learn to read this moment as a signal of smart money preparing to step away, the confusion that most traders feel at the end of a trend begins to fade. You start to see the narrative clearly. You begin to anticipate the next phase rather than being caught off guard by it. This shift in understanding is what separates reactive traders from strategic ones. Reactive traders buy the UTAD, thinking the move represents strength. Strategic traders recognize the UTAD as the sign that smart money is finished with strength and preparing for weakness. One group walks into the trap, the other quietly observes and prepares for what the market is about to reveal.